Hello and good morning, everybody. You're with Martin Panev, Chief Account Executive and Trading Analyst, GDMFX. Welcome to today's European session markets outlook. As usual, starting with short coverage of the North American markets. Yesterday, both main indexes were pretty much going sideways. No big movements there. The dollar index, though, the Dixie index is down to 95.60 from 96. ISM manufacturing PMI weaker than the expectations yesterday. The ISM prices paid also weaker than the expectations at 53 points. Initial jobless claims, 2,000 better than the expectations. Unit labor cost, 2.2% better. Non-farm productivity, as expected, minus 0.6%. The market manufacturing PMI, weaker than the expectations at 52. Construction spending, again, weaker than the expectations. And we also have the same report from Canada. Weak. USD disappointingly failed to maintain its heavily demanded week when the ISM PMIs not only fell short of expectations but also showed a slight contraction by slipping across the 50 mark to the downside. This data pattern, however, has been consistent for the dollar, where it has failed to show any upbeat prints through its past months. The job markets has been able to stand out from the trend, so it's difficult to read too much into what exactly the report today will show. Risks might be to the downside, and even more so that Fed Master yesterday has stated that employment has reached capacity and 75,000 up to 100,000 a month will be enough to maintain the rate. A figure like this today would surely a slum on the Dixie, possibly back to 94 points. With September's expectations likely to drop into 12 to 18% range that it had maintained before Yellen's last week. Fed Master on the whole was neutral, offering little to support the dovish or hawkish side of the fundamental analysis. Today, we have the non-farm payrolls, unemployment rate as well, and labor force participation rate, average hourly earnings. That's going to be year-on-year report. We also have average weekly hours, trade balance, and factory orders month-on-month. Big day for the dollar today. Moving to the European markets. Yesterday we had a decline in the DAX and the CAC 40, 60 points drop for the DAX, 16 points for the French indice. Swiss retail sales year on year minus 2.2. Spanish manufacturing PMI 51 points versus 50 expected and 52 previous. Italian manufacturing PMI was 49.8 versus 51.3 expected and 51.2 previous. French final manufacturing PMI also came revised higher to 48.3 versus steady 48.5 expected. German final manufacturing PMI unchanged at 53.6, which was as the expectations, and Swiss manufacturing PMI 51 versus 50.6 expected and 50.1 previous. Eurozone final manufacturing PMI revised lower to 51.7 from 51.8. Yesterday, the Swissy was a leader in the traders. Most Swissy pairs traded in rather good ranges. The Swissy first weakened across the board when the session opened. It then barely budged with Switzerland's retail sales report was released, but weakened some more when Switzerland's manufacturing PMI came in better than expected. After that, the Swissy began clawing its way higher against most of its Forex rivals, despite the risk-on mood, and even though there were no catalysts to catalyze the trading. In numbers versus the dollar and the euro, the Swissy was up by 130 points versus the Canadian dollar was down by 50. Today, we have unemployment numbers coming out from Spain. We have a gross domestic product report from Italy as well, and the European Union reporting on PMI month-on-month and year-on-year, along with the weekly commitments of traders report, which will show the trend on the currency. Moving to the UK markets, yesterday the FTSE 100 was 14 points down. It closed at 6,770 yesterday. Market manufacturing PMI 4.3 points better than the expectations at 53.3. The sterling rallied after an unexpectedly positive data from the manufacturing field. The report jolted with 4.3 points to a 10-month high and crossed the crucial 50-point mark to signal that the field is once again expanding after it contracted below 50. This was right after the Brexit vote. Apparently, the weakening of the UK currency had a positive effect on the British manufacturers by making them more compatible in the rather sluggish global growth environment. The pound sterling has its biggest run in the last 4 weeks, gaining 1.3% versus the greenback and 1% versus the euro, which was quite positive. The data has also reduced the possibility for another rate cut from the Bank of England this year. Currently, the markets are pricing a possible rate cut at 27%, so 1/3. In numbers, the cable 140 pips up yesterday, 200 range versus the yen 135 pips up, 270 pips range going sideways today versus the Aussie 150 pips up yesterday, 270 range, pretty much sideways as well today versus the Canadian loonie 170 pips up yesterday, 275 pips range. And versus the New Zealand dollar 80 pips up yesterday, 285 pips range. As I mentioned, also the Swiss franc did play a role, 90 pips up yesterday, 175 pips range going pretty much sideways today. On the agenda, we have the PMI construction and the CFTC pound net position from the weekly commitments traders report. Moving to the Asian Pacific field, Nikkei 225 was 15 points up yesterday. It did a huge range though, over 200 points range. Monetary base year on year for the month of August, 1.1% better than the expectations and 0.5 weaker than previous. Consumer confidence index for the month of August, again 0.4 better than the expectations and better than previous. Also, we had some form of a, let's say between 70 and 80 pips range versus the Japanese pairs yesterday. No events for the Asian Pacific markets scheduled for Friday. Next week, we have the TD securities inflation for the Aussie year on year and month on month. We also have the Caixin China Services PMI for the month of August. And on Tuesday, we're going to be looking very closely at the Royal Bank of Australia interest rate statement and decision. Commodity sector, S&P 500 index had a range of 250 points yesterday, closed near the opening levels though. It was pretty much a dodgy candle. Moves in financial markets were mostly modest amid the countdown to key American jobs data, which was seen shaping expectations for the timing of the next US interest rate hike. The crude traded below $44 a barrel and was set for its biggest weekly drop since January, having tumbled after the US stockpiles data reinforced concern about a glut. The gold declines this week and US treasuries are advancing. In numbers, yesterday the crude oil, the WTI, ended up with $1.30 on minus. $3.70 for the week, by the way, 21 cents up for silver and $4 for gold. The gold and oil net positions reports will try to show the stability of the trend on both instruments by the end of the trading day. That is pretty much all from me from today. Thank you very much for your attention. I wish you a successful trading day. Cheers, bye-bye.